Imagine a price that moves completely randomly. No trend, no pattern, no predictable direction. Just pure noise unfolding step by step. At first glance, this kind of movement seems and looks meaningless, almost chaotic, but surprisingly, this exact type of randomness forms the foundation of modern financial theory. Let's start simple, each step at a time. The price either moves up or it moves down, and both outcomes are equally likely. There's no bias, no hidden signal, no advantage. Just a 50-50 chance at every step. This process is called a discrete random walk. It's one of the simplest mathematical models of randomness, yet it already begins to capture how unpredictable price movements can be when viewed step by step over time. Now let's push this idea further. Imagine shrinking the time between each step. Movements become smaller, but they appear more frequently. Instead of large jumps at fixed intervals, we now have tiny fluctuations occurring almost continuously. At step size approaches zero and the number of steps increases without bound, this jagged path begins to transform. It no longer looks like a sequence of discrete moves, but something smoother, something continuous. This limiting process is known as the Brownian motion. It's a continuous time stochastic process, a mathematical object used to model randomness evolving over time without interruption. Rather than jumping from point to point, the path now flows continuously, but it never loses its randomness. At every instant, it is still completely unpredictable, yet fully defined by precise mathematical rules. One of the most important properties of Brownian motion is how its values are distributed. At any fixed time t, the position of the process follows a normal distribution. That means if you were to simulate this process many times and look at where it ends up at time t, those outcomes would form the familiar bell curve. The mean of this distribution is zero, reflecting the fact that there is no upward or downward drift, and the variance is equal to the time itself, meaning that uncertainty grows as time passes. This all leads to a subtle but critical insight. Uncertainty does not grow linearly with time. It grows with the square root of time. In practical terms, this means that if you double the time horizon, the uncertainty doesn't double, it increases, but at a slower rate, following a square root relationship. This scaling behavior is one of the key signatures of Brownian motion, and it plays a central role in how risk is modeled in finance. Another defining feature of this process is independence. Each movement is completely independent of what came before it. The path has no influence on the future. There is no memory, no momentum, no hidden dependence between steps. Every increment is fresh, random, and unaffected by the path taken to get there. This property is known as independent increments, and it's what makes Brownian motion such a clean and powerful mathematical model. Despite its simplicity, Brownian motion sits at the core of some of the most important models in quantitative finance. It underpins option pricing, models like Black-Scholes, drives Monte Carlo simulations used to estimate risk, and forms the basis of stochastic calculus, the mathematical language of modern finance. So, while it may begin as a simple idea, a random path with no direction, it ultimately becomes one of the most powerful tools for understanding how markets behave. And if you understand this process, you're already starting to think like a quant.